Have you ever loaned money to a family member? Or maybe sold some property to a relative? Or even to a business you have a stake in?
Yeah, lots of people do.
Right. And it seems straightforward, just a personal deal or maybe a simple business transaction.
hmm
But what seems simple could actually be hiding some pretty significant tax implications,
hmm
things you probably never even considered.
Absolutely. That's often the case.
So today we're doing a deep dive into these kind of intricate rules around related party transactions and also below market loans.
Two big areas.
Yeah, and we'll uncover how these seemingly innocent deals can surprisingly impact your tax picture.
And understanding these rules, it's not just about, dodging penalties.
No, definitely not. It's really about unlocking some strategic tax planning opportunities, making truly informed financial decisions.
Exactly. And what's really fascinating here is how the Internal Revenue Code, specifically sections 267 and 7872, they almost act like guardians,
Guardians. How so?
Well, they're there to prevent taxpayers from unfairly shifting income or deductions or even property just to avoid tax, especially when close relationships are involved.
Okay, makes sense. Preventing people from gaming the system using family or controlled businesses.
Precisely. So we'll explore the definitions, which are surprisingly broad, of who actually counts as a related party.
And how ownership can be constructively attributed. I hear that term a lot.
Yeah, it's key how ownership gets attributed across this complex web, and then the critical tax consequences for capital gains, losses, basis.
Basis, right. It's always important.
And even those seemingly simple loans between family or, business entities.
So this deep dive, it's really aiming to reveal how much more there is to know about these kind of hidden connections that bind our financial lives.
And how understanding them can actually, save you money in the long run, or at least prevent costly mistakes.
Okay, let's get into it then. Section 1. The hidden connections defining related parties and this idea of constructive ownership. So when we talk about related party transactions, it sounds simple enough, but you're saying the IRS definition is different.
Specific, yeah, and broader than most people think. And the core reason these rules exist, especially under Section 267, it's fundamental. It's about tax system integrity.
Integrity.
Yeah, the government wants to prevent taxpayers from, let's say, artificially shifting ownership of stock or property to someone they're closely connected with.
Just to get a tax break they wouldn't normally qualify for.
Exactly. Imagine, trying to claim a tax loss on a sale to your sister, knowing full well the property's basically staying within the family's economic unit.
Or trying to defer income when you still effectively control the asset through maybe a company you own.
That's it. Section 267 is designed precisely to stop that kind of maneuvering. It's about making sure transactions are treated as arm's length for tax purposes, even if they're not in reality.
Okay, so looking past the surface level.
Right. Looking through the superficial layers to the actual economic reality. And to do that, Section 267 introduces these absolutely crucial constructive ownership rules.
Okay, constructive ownership. Let's break that down.
It means that stock or property that's legally held by certain parties who are related to you, well, it's treated as though it's actually held by you.
So the IRS puts on X-ray glasses.
Kind of, yeah. That's a good way to put it. They don't just see who holds the legal title. They look through the layers of companies, family relationships.
To see who really has the economic control or influence.
Exactly. And this concept, constructive ownership, it's the key that unlocks all the complexities here. It's vital for avoiding unexpected tax traps.
Okay. And you mentioned something specific about personal service corporations.
Ah, yes, that's a really important one, often overlooked. Any transaction between a personal services corporation, think like a doctor's practice, a law firm, an accounting firm set up as a corporation, and an employee who owns part of it, even a tiny part. That transaction is automatically classified as being between related parties.
Automatically. Regardless of the ownership percentage.
Regardless. Even if it's just 5% or 10%, doesn't matter. That can be a huge trap for small business owners or professionals. They might not realize their small holding triggers these rules.
Which could mean disallowed deductions or income being recharacterized.
Potentially, yes. It changes the whole tax picture for that transaction.
Wow. Okay, so if the IRS is using these X-ray glasses, who exactly are they looking for? Who are these related parties? And it's not always obvious, right?
Not always, no. And Section 267 gives a surprisingly specific and sometimes, like you said, counterintuitive list. You absolutely need to know who's on it.
Let's go through it then.
Okay, first the obvious ones, maybe. Family relationships. This includes brothers and sisters.
Full and half siblings.
Yes, both. Spouses, of course. And then ancestors and lineal descendants.
The parents, grandparents, kids, grandkids.
Okay.
A direct line up and down.
Exactly, your direct bloodline. But here's a crucial distinction, something often missed.
What's that?
In-laws and step relationships are not considered related parties under this specific section, Section 267.
Really? So my son-in-law isn't related for these purposes?
Correct. That's a vital detail. It can make a big difference in how you structure things. Selling a lost asset to your son might trigger the rules, but selling it to your son-in-law generally won't face the same automatic disallowance.
Huh. Interesting. Okay, what about businesses and entities?
Right. Beyond individuals, it gets into entity relationships. And this is where control gets more complex. Any entity could be a corporation, partnership, trust that's more than 50% owned, directly or indirectly.
Ah, indirectly. There's that constructive ownership again.
Exactly. More than 50% owned by individuals, corporations, trusts, or partnerships. You have to trace the ownership.
Yeah.
Then there are controlled groups. Think of two businesses, maybe two corporations, or a corp and a partnership where the same party owns more than 50% of both.
So the IRS sees them as one economic unit.
Pretty much, yeah, for these rules. Prevents one from selling at a loss to the other just for a tax deduction when it's all under the same ultimate control.
Got it. What else?
There are also complex rules involving trusts, grantors, fiduciaries, executors, beneficiaries. That gets deep into estate planning.
Right.
And finally, tax-exempt organizations, like charities under Section 501, are related to the person who controls them, directly or indirectly. Prevents misuse.
So understanding this definition, broad but specific, is really the first step.
It's absolutely step one. Avoids surprises, helps you spot potential planning opportunities. It's not just bloodlines, it's this specific legal framework.
Knowing it lets you plan transactions properly.
And that brings us to digging deeper into those constructive ownership rules themselves. Because just knowing who's related isn't enough. You need to know how their ownership can be attributed to you, often in ways that aren't obvious at first glance.
Okay, let's peel back another layer then. How do these attribution rules actually work?
There are basically three key rules under Section 267.
Okay, rule number one.
Rule one is proportionate attribution. Stock owned, directly or indirectly, by a corporation, partnership, estate, or trust. It's treated as owned proportionately by its shareholders, partners, or beneficiaries.
That the IRS looks through the entity?
Exactly. They look through to see who ultimately benefits. Let's use an example. Say, Kathy owns 80% of Handlebars Company.
Okay.
And Handlebars Company owns 30% of ABC Company.
Right.
To figure out Kathy's ownership in ABC for related party tests, we apply Rule 1. Kathy is treated as owning 24% of ABC Company.
How'd you get that?
It's her 80% ownership in Handlebars times Handlebars' 30% ownership in ABC. 80% of 30% is 24%.
Ah, okay. So it extends her ownership beyond just what she holds directly.
Precisely. This means even if you don't directly own over 50%, your indirect ownership through other entities could push you over that threshold. Suddenly, parties you thought were unrelated become related.
Which changes everything for transactions with that company.
Definitely. Sales, deductions, the works.
Okay, that's rule one. What's rule two?
Rule 2 is family attribution. This one's maybe more intuitive. An individual is considered to own the stock owned by those specific family members we listed earlier.
Brothers, sisters, spouse, ancestors, lineal descendants.
Right. So their stock gets added to yours for the tests. Let's take Chad. He owns 30% of Wick Corp.
Okay.
His wife, Kathy, owns 20%. His grandson owns 5%. And his nephew owns 15%.
Nephew. He's out on the list, right?
Correct. Nephews aren't related under Section 267. So to figure Chad's total ownership, we add his 30%, his wife Kathy's 20%, and his grandson's 5%.
It's 55%.
Exactly. So Chad is treated as owning 55% of Wick Corp. The nephew's 15% is ignored for this purpose.
So you really have to be precise about identifying exactly who counts as family under these rules.
You do. Extreme precision is needed. Small family holdings can combine to push you over 50% and trigger related party status unexpectedly.
Okay, rule one is through entities. Rule two is family attribution. What's rule three?
Rule 3 is about how these rules interact. It's crucial for understanding how attribution can cascade, but also where it stops.
Cascade, like a chain reaction.
Sort of. Stock that's constructively owned by someone under Rule 1, that's the proportionate attribution through entities, is treated as actually owned by that person when you then go to apply either Rule 1 again or Rule 2 in other situations.
So ownership attributed through a company becomes solid, like real ownership, for the next step.
Yes, it's like a building block. Once constructed, it can be used again. Remember Kathy constructively owning 24% of ABC Company through Handlebars?
Yeah, 80% of 30%.
Right. Now, if we were testing Kathy's husband, Chad, for related party status with ABC, Kathy's 24% constructive ownership would be treated as actual ownership. Chad would add that 24% to any stock he actually owned in ABC.
Okay, so it flows from the entity to Kathy and then could potentially flow to Chad via the family rule.
It could flow to Chad via the family rule because Kathy's ownership, now treated as actual, makes them potentially related. But here's the critical limit.
What's the limit?
Rule 2, the family attribution rule, cannot be applied repeatedly in a cascading manner to other family members. Ah, okay, so you can't just keep bouncing it around the family tree indefinitely.
Exactly. It prevents what's called double attribution within the family. Let's go back to Chad and Wick Corp. Chad constructively owned his wife Kathy's 20% in Wick.
Right, making his total 55%.
That 20% that came from Kathy to Chad, it cannot then be attributed from Chad to, say, Chad's sister Shirley.
Why not?
Because that would be attributing it twice within the family. From Kathy to Chad, Rule 2, and then from Chad to Shirley, also Rule 2. The rules specifically stop that second family-to-family jump.
Okay, that's a vital circuit breaker. Prevents things from getting totally out of hand.
It's a necessary guardrail.
Yeah.
Keeps the attribution logical and prevents overreach.
Let's maybe try a more complex scenario to tie this together.
Sure, let's look at 3 corporations: Arnold Corp., Cooper Corp., and Diggins Corp.
Okay.
Arnold Corp. owns 40% of Cooper Corp. directly. Arnold also owns 30% of Diggins Corp., and Diggins Corp. in turn owns 40% of Cooper Corp.
Got it. So Arnold owns Cooper directly and also indirectly through Diggins. Right. The question is, are Arnold Corp. and Cooper Corp. related parties? Remember, the threshold is owning more than 50%.
Okay. Arnold has 40% direct ownership in Cooper. What about indirect?
I'll use Rule 1. Arnold owns 30% of Diggins, and Diggins owns 40% of Cooper. So Arnold constructively owns an additional chunk of Cooper through Diggins.
That would be 30% times 40%. 12%.
Exactly. Arnold constructively owns 12% of Cooper through Diggins.
So you add that 12% indirect ownership to Arnold's 40% direct ownership.
You do. 40% plus 12% equals 52%.
Which is more than 50%. So yes, Arnold Corp. and Cooper Corp. are related parties.
Correct. Even though the direct ownership was only 40%, the indirect link through Diggins pushed it over the threshold.
Wow. That really shows you have to trace everything. You can't just look at direct ownership lines.
Absolutely not. For businesses especially, this means seemingly separate companies might be related if their ultimate ownership traces back to the same place. Disallowed losses, recharacterized income. It can all happen if you're not tracking this stuff.
So proactive corporate structuring and, auditing your ownership chain seems pretty essential.
It really is. Avoids these hidden traps.
So the bottom line here is, you really need to map out this complex web direct, indirect family ties to truly understand who the IRS considers your related parties.
That's your first line of defense, and offense, really, in effective tax planning.
Okay, that makes sense. So now that we've figured out who is related, let's talk about what happens when they actually do transactions. Section 2, gains, losses, and basis.
Right, the consequences.
Let's start with capital gains. What's the general rule when related parties sell property, like land?
The general rule is pretty straightforward. Capital gains taxes are imposed on sales of non-depreciable property, like land, between all related parties.
So no automatic tax-free pass just because you're related?
Generally, no. That gain is usually recognized, but like always in tax, there are exceptions.
Ah, the exceptions. Always important. What are they here?
Okay, 2 key ones for capital gains. First, sales between 2 spouses.
Okay, what happens there?
No capital gains treatment. The IRS basically treats spouses as one economic unit for this. So the property's basis just transfers from one spouse to the other. No tax triggered on the transfer itself.
That sounds useful for, estate planning or just moving assets between spouses?
Extremely useful. Avoids immediate tax. The second exception is maybe more surprising and potentially costly if you don't know it.
Oh, what is it?
It involves sales between an individual and a corporation or partnership they control, meaning more than 50% ownership, considering those constructive rules.
Okay, individual sells to their controlled company. What happens to the gain?
Here's the twist. The gain is taxed as ordinary income, not capital gains.
Ordinary income. Wow, that could be a much higher tax rate.
It often is, significantly higher. The IRS recharacterizes it.
Mm-hmm.
They might see it as a disguised dividend if it's a corporation, or maybe compensation. It prevents people from easily converting ordinary income into lower taxed capital gains by selling appreciated assets to their own company.
So you need to be really careful selling appreciated assets to your controlled business.
Very careful. It can backfire tax-wise.
Okay, that covers gains. What about losses? If I sell something to my brother at a loss.
Losses. Here the rules get strict. There is a very clear disallowance rule. Losses are disallowed on most related party sales transactions.
Disallowed, meaning I can't deduct that loss on my tax return.
Correct. You cannot deduct it.
And this holds true even if I sold it for the actual fair market value, like an arm's length price.
Yes. Even if the price was perfectly fair market value, the relationship itself is the trigger for the disallowance, not the price.
So what does this mean for tax planning? Basically, you can't use your family or controlled businesses to generate tax losses.
That's the gist of it. You can't just sell losing stock to your sister to recognize the loss if you plan to effectively keep it in the family somehow. The IRS sees through that, prevents circumventing rules like the wash sale rule through related parties.
Okay, so the seller's loss is disallowed, but does that loss just disappear forever? What happens to the person who bought it, the related party? What's their basis?
Great question. No, the loss doesn't necessarily vanish into thin air. It's more nuanced. The tax treatment for the second buying relative, when they eventually sell the property to someone unrelated, depends entirely on their resale price.
Okay.
Our sources use a helpful analogy, likening it to gift tax basis rules. Think of it like a passkey. It unlocks the future tax treatment based on 3 scenarios when that second relative sells.
A passkey. I like that. What are the scenarios?
Scenario 1. The second relative sells the property for a price higher than the first relative's original cost basis.
So higher than what the first person originally paid for it.
Exactly. In this case, the second relative uses that original relative's basis, the first person's cost, to calculate their gain.
So the gain calculation effectively ignores the disallowed loss.
Well, it uses the disallowed loss to reduce the gain. The gain is calculated on the difference between the final selling price and the original cost basis, but it's reduced by the amount of the loss that was previously disallowed to the first seller. So the full economic gain is taxed eventually.
Okay, that makes sense. What's scenario 2?
Scenario 2. The second relative sells for a price that's between the first relative's original cost basis and the lower price they paid to the first relative, the price at which the loss was disallowed.
So in that middle ground.
Exactly. In this unique neutral zone, guess what? No gain or loss is recognized by the second seller.
Really? Zero tax impact.
Zero tax impact on that sale. It's like the transaction inside the family is disregarded until it moves outside the related group at a price that triggers either a gain relative to the original cost or a loss relative to the related party purchase price.
Interesting. Okay, scenario 3.
Scenario 3. The second relative sells for a price lower than what they originally paid the first related party for it.
So they're selling it for even less than the already reduced price.
Right. In this case, they use their own purchase price, the amount they actually paid the first relative, as their basis to determine their loss.
So they can recognize a loss in this case.
Yes, but only the loss that occurred after they acquired it. They can't benefit from the loss that was disallowed to the first seller. Their loss is based on their actual cash investment dropping further.
Okay, that prevents the first disallowed loss from ever being claimed, but allows the second person to claim their own subsequent loss.
Precisely. It accounts for the economic reality when the asset leaves the family unit, but limits the benefit.
This is best with an example, I think. Let's use Ned, Ray, and Bobby.
Okay.
Ned bought stock for $20,000. Later, he sells it to his brother Ray for $16,000.
Okay, so Ned has a $4,000 economic loss, but because Ray is his brother, that $4,000 loss is disallowed for Ned under Section 267.
Right. Now, sometime later, Ray sells the stock to Bobby, who is unrelated, for $21,000.
Okay, so Ray bought for $16K, sells for $21K. Seemed like a $5K gain, but wait.
Exactly. We need to factor in Ned's disallowed loss, right? Using that passkey idea. Which scenario are we in?
Well, Ray sold for $21,000. That's higher than Ned's original cost basis of $20,000. So we're in scenario 1.
Sell higher. So Ray uses Ned's original basis, but adjusted. How?
Right. Ray's selling price is $21,000. His basis for calculating the gain isn't just his $16,000 cost. He gets to effectively use Ned's disallowed loss of $4,000 to offset his gain. So his recognized gain is the $21,000 selling price minus $16,000 cost plus $4,000 disallowed loss.
So $21,000 minus $20,000.
Exactly. Ray's recognized gain is only $1,000.
Not the $5,000 apparent gain.
Correct. The $4,000 disallowed loss for Ned sheltered $4,000 of Ray's gain when he sold it outside the family.
Okay, now here's where it gets really interesting, as you say. This shows the disallowed loss isn't just lost, it's deferred, right? It effectively adjusts the basis for the next buyer, Ray, but only when Ray sells to an unrelated party.
That's the perfect way to put it. It's a deferral mechanism, not a permanent penalty on the family's economic loss. The IRS just makes sure you don't claim it prematurely while the asset is still within the related group.
So knowing this, you could potentially plan intra-family transfers knowing the loss might be usable later by the buyer against a future gain.
It definitely allows for longer-term tax thinking within a family unit or controlled group. You ensure the loss isn't permanently wasted, just timed differently.
Okay, that's crucial. What about the holding period? If Ned held the stock 10 years, does Ray get that long-term holding period?
Good question. No, the holding period for the purchasing relative, Ray in this case, starts fresh with his own period of ownership.
So even if Ned held it 10 years, if Ray sells it after 3 months to Bobby, Ray's $1,000 gain is short-term.
Correct. Short-term capital gain. It prevents related parties from artificially creating long-term gains just by passing assets around.
Makes sense. Okay, one more thing in this section. The matching rule for expenses between related parties.
Yes, the matching principle. This is super important, especially for small businesses or family-owned setups where accounting methods might differ.
Like one is accrual basis, the other cash basis.
Exactly. The rule states that an accrual basis taxpayer, say, a company cannot deduct an expense owed to a cash basis related party, say, the owner, until the related party actually receives the payment and recognizes it as income.
So the deduction is deferred until the income is recognized.
Precisely. Think about common examples. Compensation owed to an owner-employee, rent owed for a building the owner leases to the company, interest on a loan from the owner to the company.
Right.
If the company is accrual and the owner is cash basis, the company can't deduct that accrued salary, rent, or interest expense in year 1 if the owner doesn't actually get paid and report the income until year 2.
It prevents the company getting a deduction now while the owner pushes the income off to a later year.
Exactly. It prevents that timing mismatch that could defer taxes unfairly. So this raises a question for anyone running a business with related parties.
Are you accidentally deferring deductions?
Yeah. Are you creating a timing mismatch that delays deductions your business could use now? The simple fix is often to ensure payments are made within the same tax year or consider aligning accounting methods if feasible.
Good practical advice. Okay,
Yeah.
let's move to the third big area, loans. Specifically, loans that might not be just loans in the eyes of the IRS. Imputed interest.
Right. Section 7872. This deals with below-market loans.
Below market meaning charging less interest than the going rate, or even zero interest.
Exactly. The purpose of Section 7872 is to prevent parties from using these low or zero interest loans, especially between related parties, as a disguised way to transfer value tax-free.
Like a parent lending a kid money interest-free for a house down payment, or a company giving its shareholder an interest-free loan instead of a taxable dividend.
Those are classic examples. The IRS sees these potentially as attempts to transfer wealth or compensation or dividends without paying the appropriate tax.
Okay, let's unpack this. If Section 7872 applies, what happens? The loan isn't just ignored, right?
No, definitely not ignored. It gets recharacterized for tax purposes. It's treated as if 2 transactions happened.
2 transactions, yes.
First, the IRS treats it as if the lender made a loan to the borrower requiring interest payments at the applicable federal rate, or AFR.
AFR, where does that come from?
The IRS publishes these rates monthly. They vary based on the loan term, short, mid, long term. They represent a sort of minimum market rate the IRS expects.
Okay, so transaction 1 is a pretend loan at the AFR. What's transaction 2?
Transaction 2 deals with the missing interest, the difference between the AFR and the interest actually charged, if any. The IRS treats this difference, called foregone interest, as if it were transferred from the lender to the borrower,
Okay.
and then immediately transferred back from the borrower to the lender as an interest payment.
Whoa. Okay, that sounds complicated. What are the consequences of that?
They can be significant. The lender generally has to report that foregone interest as interest income on their tax return.
Even if they never actually received the cash.
Even if they never received a dime of it, it's phantom income.
Phantom income? Ouch. What about the borrower?
The borrower might get to deduct that foregone interest they supposedly paid back, unless it's considered personal interest.
Which it often is in family loan situations, right?
Yeah.
And personal interest usually isn't deductible.
Exactly. So you can easily end up with the lender having taxable phantom income and the borrower getting no deduction. A tax headache created out of what seemed like a simple, helpful loan.
Yikes. So what kinds of loans does this apply to? It sounds pretty broad.
It is broad. What's fascinating is how wide the net is cast. Let's list the main categories affected.
Okay.
First, gift loans. Any below-market loan that's essentially a gift, super common between family members, like that parent-child house loan example. The foregone interest is treated as a gift from lender to borrower, then interest income back to the lender.
Got it. What else?
Second, compensation-related loans. Loans between employers and employees or independent contractors and the people they work for. Think interest-free salary advances or low-interest relocation loans.
The foregone interest is treated like extra wages.
Exactly. Taxable compensation to the employee and potential interest income to the employer, who also gets a corresponding compensation deduction usually.
Okay. Third,
Corporation shareholder loans. Below-market loans between a corporation and its shareholders. The IRS watches these closely to prevent disguised dividends.
so the foregone interest looks like a dividend payment.
Generally, yes. Taxable dividend to the shareholder, interest income to the corporation.
Right. Any others?
There's a broad tax avoidance loans category. This catches any below-market loan where a principal purpose is avoiding any federal tax. Gives the IRS a lot of leeway.
A catch-all.
Pretty much. And then there are other below-market loans mentioned in regulations if they significantly affect tax liability, plus a very specific one for loans to qualified continuing care facilities.
So the message is, assume almost any below-market loan, especially between related parties, could be under scrutiny.
That's the safe assumption, yes. The rules are designed to cover almost any situation where value might be transferred indirectly via loan terms.
Okay, so given how broad that is, what does this all mean for you if you were considering a loan like this? Are there ways out? Any exceptions?
Yes, thankfully. There are some crucial exceptions that are vital for avoiding this imputed interest mess. Knowing these can save a lot of trouble.
Let's hear them. What's the first one?
The de minimis exception, basically for small loans.
How small?
For gift loans directly between individuals, the imputed interest rules simply do not apply on any day where the total outstanding loans between those two specific people do not exceed $10,000.
$10,000. Okay, so a small loan to help your niece buy a car, if it's under $10 and that's the only loan, is probably fine.
Generally, yes. That $10K threshold provides a safe harbor for many typical small family loans.
Does that limit also apply to business-related loans?
Yes. Similarly, for compensation-related and corporate shareholder loans, the rules don't apply if the total outstanding loans between the borrower and lender don't exceed $10,000.
So a $10 ceiling for avoiding imputed interest on small loans, whether personal or business.
Correct. It's a very practical exception.
Are there others? What about slightly larger family loans?
Yes, there's another very important set of rules, specifically for gift loans not exceeding $100,000.
Okay, loans up to $100,000, that covers more significant family help. What's the special rule?
If the total outstanding gift loans between the lender and borrower are $100,000 or less, the amount of foregone interest the lender has to include in income is limited.
Limited to what?
It's limited to the borrower's net investment income for the year.
Net investment income.
Right.
Like interest, dividends, capital gains.
Exactly. Things like that. Not usually wages or active business income. So if the borrower doesn't have much investment income, the lender's phantom income is capped at that low amount.
Okay, that's helpful.
And it gets even better. If the borrower's net investment income for the year is $1,000 or less, then the foregone interest the lender has to report is treated as zero.
Zero. So if I lend my kid $90,000 interest-free for grad school, and they have basically no investment income while they're a student.
Then, under this rule, you, the lender, would likely have zero imputed interest income to report, even though the loan is large and below market.
Wow. That's a huge planning opportunity for families.
It really is. It means many substantial family loans under $100K can be structured without triggering imputed interest, as long as the borrower's investment income is minimal. It raises that question again.
Are you structuring family loans to take advantage of these exceptions effectively?
Exactly. Using these rules strategically can avoid unexpected tax hits and facilitate wealth transfer smoothly.
Okay, great exceptions. But if a loan doesn't meet an exception, how do we calculate that hidden or foregone interest?
The formula itself is relatively simple. You calculate the interest that would be payable if the loan charged the applicable federal rate, AFR, for that period, payable annually December 31st.
Okay, interest at the AFR rate.
Then you subtract any interest that was actually payable on the loan for that period according to its terms.
And the difference is the foregone interest, the phantom income.
That difference is the foregone interest, yes.
Let's do that Mike and Angie example to make it concrete.
Okay. Mike loans $200,000 to his sister, Angie.
Related party, gift loan context.
Right. Payable in 10 years, and the interest rate is only 1% per year.
Very low. Below market.
Definitely. And let's say the IRS's applicable federal rate, AFR, for long-term loans at that time is 2.24%.
Okay. Does Section 7872 apply here?
Yes. It's a below-market gift loan between individuals, and the amount, $200,000, is way over the $100,000 threshold for this special net investment income limitation. So the main rules apply.
All right, let's calculate the imputed interest. Step 1, interest at AFR.
Step 1, AFR interest. That's 2.24% times $200,000 principal, which equals $4,480.
Okay, $4,480 is what the IRS thinks the interest should have been. Step 2, actual interest.
Step 2, subtract the interest actually payable. That's 1% times $200,000, which is $2,000.
So $4,480 minus $2,000.
Equals $2,480. That's the imputed interest, the foregone interest.
And here's the kicker, right? What happens with that $2,480?
Here's where it gets really interesting and potentially costly. Mike, the lender, has to report that $2,480 as interest income on his tax return.
Even though Angie never paid it to him. Phantom income.
Pure phantom income. And Angie, the borrower, can she deduct the $2,480 she supposedly paid?
Probably not, right? Because it's likely personal interest from a gift loan.
Almost certainly personal interest, so generally non-deductible for Angie.
So Mike pays tax on income he didn't get, and Angie gets no deduction. Ouch.
It highlights perfectly how crucial it is to know the AFR and structure loans accordingly. If Mike had just charged Angie the 2.24% AFR,
this whole imputed interest problem disappears.
Exactly. No phantom income for Mike. It shows how proactive planning, even just checking the AFR rates, can prevent these kinds of costly surprises.
Definitely a key takeaway. Okay, let's wrap things up. We've covered a lot of ground.
We have navigated some complex territory.
Related party transactions, constructive ownership, gains, disallowed losses, basis adjustments, imputed interest. What we've really learned, I think, is that the IRS looks far beyond just the surface of your financial deals, especially when family or close business ties are involved.
Yeah, these aren't just obscure little rules buried somewhere. They actively shape how these common transactions are taxed, and that directly impacts your bottom line.
So the key takeaway isn't about finding loopholes, right?
No, not at all. It's about being proactive and strategic. Understanding Sections 267 and 7872 lets you anticipate the tax consequences.
So you can structure things compliantly.
And, importantly, avoid those unexpected, often costly tax liabilities. It's about knowing the difference between a genuine gift or a proper business loan versus something the IRS might look at and say, hang on, this looks like disguised income, or nope, you can't deduct that loss.
Yeah, being aware of how they define related party, how constructive ownership works. It lets you align your transactions with the rules.
Or leverage those exceptions we talked about, like the $10 or $100K loan rules for potentially significant tax savings.
Yeah.
It's about being informed.
Right. From selling property between siblings to just making a casual loan to your kid, these rules can turn something simple into a complex tax event if you're not careful. So being well-informed means you can make decisions that actually serve your financial goals, avoid those nasty surprises, and just generally achieve better outcomes.
It's about taking control rather than being caught off guard by the tax code.
Well put. So, as we finish up, maybe a final thought for our listeners to consider.
Yeah, definitely. This raises an important question for you to think about. Are there any seemingly innocent transactions in your own financial history or maybe in your future plans, transactions with family members or with businesses you control that might inadvertently trigger these rules we've discussed today?
Things you haven't thought about through this lens before.
Exactly. How might taking a deeper dive into your specific circumstances reveal some hidden tax considerations, or maybe even some smart planning opportunities?
Good question to ponder. We really hope this deep dive has given everyone some powerful new insights into this area. It really does impact a lot more people than probably realize it. Remember, staying informed, being proactive, that's always your best strategy for navigating the complexities of the financial world.